School get started, others maybe come in a few minutes. Five screens. For the frame. There's Chandler's here, there's Satan's here. Evan's here. Alexander's here. Altman out here yet. Even also going to make it this morning. Osborne is here, Robert Harris, here, Dylan. Okay, both of the Millie and Malaikas are coming. Okay. Wendy's here, Kelly. Jessica. Kelly's here. Open's here. Evo's here. Carson. Carlos, I guess he's going to make it with Alton. Kenny Wales, Jacob, Christopher's up here, and Frank Coe. Okay, now, Cengage. How many has finished chapter 11? Cengage. What? You started it? What did you do on it? Chapter 11.
Payroll,
I know.
journalizing
What
payroll.
was your final score? Okay. Who else finished? Oh, somebody else had finished. Okay. Anyway, Kelly, you not finished? Yeah. So we're on first. All right. Cengage, chapter 11, will be finished by 30. Okay. You get that one, you should do it. Okay. But we'll help you review the chapter on payroll and on short-term notes and all the short-term liabilities with each payable and I guess warranty payable and vacation payable, but you had all the payroll payable, whether it be salaries payable or Social Security payable, Medicare payable, state income tax, or federal income tax. So we have a lot of liability. That's what chapter 11 is all about. All right, try to finish Cengage by Thursday. We need to get this chapter behind us because this is week 2, isn't it? Okay. Did anybody have class yesterday morning? Did anybody have class on Monday? Nobody had a class on Monday morning? What was it, 0 or minus 1 or 2 up here? 3 degrees? Okay, it was cold yesterday morning, I know that. I know you're glad you didn't have class, especially an 8 o'clock class. When Arthur, come in. Carlos, you all ready to play tennis? How about are you ready for accounting? All right. Okay, I asked you to do some problems, so we're going to review a few problems in this chapter, and we'll wrap it up. We're going to start another chapter, of course. And we'll get back to this one later for some review, what have you. But in this chapter, if we give somebody a note for our accounts payable, what is that rule? We give somebody a note, but we can't pay our accounts payable. So what do we do? Credit note payable, and debit account payable. Now, if we borrowed cash from the bank, with debit cash, credit note payable. If we bought a piece of equipment, and gave a note to accounts payable with debit equipment and credit note payable. So there's three ways you get a note payable on your books. And then when you pay it, you have to pay interest. Now, what did discounting the note mean? What did discounting the note? Do you remember what that meant? If you discount a note, it means taking interest down up front in advance. You send it back to him. And that's more of a rate than what it appears. It's more of a bigger APR. Okay, what problems did I ask you to look at today? It's the end of your chapter. William, do you have those down?
1, 2, and 5 on 572.
All right, problems 1, 2, and 5. Let's look at those real quick. First off, does anybody have a question on Cengage? Has anything stuck you on Cengage? Obviously, you can make 100 on it, and there's not any mistakes in some of the problems, like, you know, there can be and has been. Hey, on page 572, the first problem, and the problems are bigger and better, I guess, than the exercise. If you do the problems, you got this chapter down, or you got it comprehended. Okay, on the first problem, we purchase merchandise on account. William, that's an easy little entry. What do you debit?
You debit merchandise inventory.
And credit?
Credit accounts payable.
All right. Now that's a generic entry that we've had in many past chapters, especially on merchandising. These are messed up or overlapped or something, so I don't believe it's going to show up very good on some of these. But debit merchandise inventory, credit accounts payable. Now we issued a 30-day note for $240,000 to this Laney company on account. Okay, Sage, how about that one? Just debit what?
You debit
And credit what?
that accounts payable.
Okay. That's the same question I think I asked Morgan. I'm going to give you, say, a note for my accounts payable. I want rid of accounts payable. It's not going to be a liability anymore. So how do I get rid of accounts payable? Yeah. Okay. Now, I want a notes payable on my books. That's a liability. What do you do with a liability? Credit notes payable. Okay, so debit accounts payable and credit notes payable. And again, here's where I think all these are starting to overlap or bunch up. All right, we paid the amount owed on the note of February the 9th. All right, if you're calculating interest on a 30-day note at 4%, what is the interest? 240,000 times decimal 04 times 30 over 360. How much interest is that? Jessica? All right, what would be your entry?
Notes payable for 240,000, interest expense debited for 800, and cash credited for 240,800.
I don't think that's gonna show up at all. Shows up confusion if anything, but it is here. Notes payable 240, interest expense 800, and cash 240,800. All right, we borrowed 160,000 from a bank. We issued a 5% note. How about that one, Alexandra? We just
You'll debit cash for $160,000, and credit, notes payable.
How much was that one for?
$160,000.
Yeah, that's not gonna show up at all. But, debit your cash and credit your notes payable. That's all you have to do. We purchased tools by issuing 180,000 60-day note. Okay, we're getting another notes payable on there. How about that one?
So bear with me because I may get this one wrong, but, you would, debit, tools for 180,000 or supplies or something like that. I'd probably put tools for 180,000. And then you would, credit notes payable for,
Same thing.
we have a discount on there.
Was it discounted?
Yeah, so I'm trying to think of the discounted, but it's $178,500. How much you need to pay back, and then the discount's $1,500.
All right, so you're gonna debit tools for 178,500. Debit the interest expense 500, credit notes payable.
Okay.
So when it's discounted like that, the tools are not they're not 180,000. So you're getting a note on the books, you borrowed cash, credit notes payable. You swapped your accounts payable, credit notes payable. Now you're buying tools, credit notes payable. 3 ways you get a notes payable on your book. And sorry about these transparencies, they're really, problem 1 was awful. Anyway, we'll get through it. Now we paid the bank the interest due on the note of May 1st and renewed the loan by issuing another note. All right. Journalized both the debit and credit to the notes payable. All right. We paid the interest. What was the interest on that Tabitha bank note? 45 days at 5%. What is 160,000 times 5% times 45 over 360? What is that? Anybody? What is? How much?
1,000.
All right, you got a debit notes payable for whatever the amount that says. Now here's the trick to that: when you credit notes payable for the same amount, it's a new note. All right, but you debit interest expense for the 1,000 and you credit cash because you paid the interest expense for 1,000. Okay. Now we're going to pay the bank the amount due on the note of June the 15th. All right. Here's where we debit notes payable for 160,000. And what do we debit interest expense for? 7%. How much? 45 days, 7%. Still 1,000. I don't know. It was
1,400.
Well, it was 5%. It's 1,000, so it couldn't be 1,000 for 7%. So it's 1,400. Okay. So we debit the notes payable 160,000. We debit interest expense 1,400. We credit cash for 161,000. What, 400? Now we're going to pay the amount due on the note of June the 1st. That's when we purchased tools. Carson, any idea what that entry would be for June the 3rd? 30. No, I know you can't. I can't either. Anybody, what's that entry? Notes payable, debit, credit cash. Why do you not know the note was 180,000? So you already took the interest out in advance. So you're paying the whole note, 180,000 debit, credit cash, 180,000. Yeah, these are not going to make sense. Purchased office equipment, paying 100,000 and issuing a series of 10 5% notes, 30,000 each. Well, I don't want you to credit notes payable 10 times. All right. So you debit here office equipment for 400,000, I suppose. You credit cash for 100,000, and you credit notes payable for how much? 300,000. Settled a product warranty lawsuit with a customer for 260,000, payable in January. O'Donnell accrued the loss in a litigation claim payable account. So I suppose it would be litigation claims payable debit 260 and credit what? If we settled it, we paid cash. Paid the amount due this company on the first note in the series issued on December. All right, you're going to pay a $30,000 note for how many days? December 1st to 31st. So what is the interest on 30? Wait a minute. Paid the amount due on the first note in this series. That could probably go two ways, but it's 30,000. What is 5% interest on 30,000 for 30 days?
1,000.
How much?
1,000.
$125. Get that decimal right. 30,000 times 5% would be 1,000 something, but you got to multiply that by 30 over 360. So you debit interest expense for how much? 125, and credit cash for 30,125. Now, they didn't tell us to, but it's possible that they wanted to pay all interest on all notes. But they didn't say to do that, so we just paid interest on one 30-day note. Now, the next note, we'll have to pay interest on it for how many days? 60, wasn't it? Then the next note will be how many days? 90. So those other notes go longer. All right, I asked you to look at number 2 also, and I think my transfer is still just as bad. We might get an entry out of it, I don't know. These come from the company and why they mess them up so bad. All right, now this is payroll. We've got tax rates assumed. They give you those. Federal unemployment tax, employers only decimal 6. They should have at least used decimal 8. It's been decimal 8 for 40 or 50 years. Assuming that the payroll for the last week of the year is to be paid on December 31st, journalize the following entries. The December 30th to accrue the payroll. All right. Now we've got salaries, sales, salaries, warehouse, salaries, office, 777,000. Income tax withheld, Social Security tax withheld, Medicare tax withheld, retirement savings, and group insurance. So we got total deductions. And we don't have to calculate the taxes because they gave those to us. All right. How about that journal entry, somebody? What's your first debit? What's your debit? You're going to debit all those salary expenses, don't you? Okay. I wish those would show up. And they're definitely messed up. Sales salaries 402. Warehouse salaries is what? Is it 210 or what?
Yeah, 210.
All right. And then office salary expense is 165. All right. Employees income tax payable. I guess that's 135,975. Social Security tax payable 46,620. Medicare tax payable 11,655. Retirement savings payable 17,094. Group insurance payable 13,986. And, was there something else there, payable?
Salaries payable.
Okay, salaries payable is down here. How much was left? 500 and what? How much?
51,607.
Oh, yeah, 551,000 what?
607.
Well, yeah, everybody can see that, can't they?
Yeah.
Okay. What a mess. Okay, now, the next one is important also. December 30 to record the employer's payroll taxes on the payroll to be paid on December 31st. Of the total payroll for the last week of the year, 40,000 is subject to unemployment taxes. Well, we know what the Social Security tax on the employer is. What is it? What is the Social Security tax on the employer?
46,000.
Because we match it, don't we? And what's the Medicare tax on the employer? All right, 11,655. Okay, but now the state unemployment, we multiply 40,000 times 5.4, and we multiply 40,000 times 0.6. That will, those four together gives us, and it's probably not going to be here anywhere. I don't even know if we can make it out or not, but it should be payroll tax expense, 60,675, Social Security tax payable 46, Medicare tax payable 11,655, state unemployment tax. What would that amount be, folks? Just multiply 40,000 times 5.4. 21 what? Okay, and then federal unemployment tax, 0.6% is 240. All right, that's the two important entries in payroll accounting. Okay, so please know those two entries. Now, two is about the same. If they were going to pay the payroll on, be paid on January 5th of the following year, journalized entry to record the payroll. And then January 5th to record the employee. All right, there's not a lot difference. There's not a whole lot of difference. Everything is going to be payable. Salaries are definitely going to be payable. B part, trying to see what the difference in B part would be. Social Security is the same. Medicare tax is the same. But where do we get this big amount? Here's what differed. State unemployment tax payable. On part B, what do we multiply 5.4% by? The total 777, because it's a new year. And we pay state and federal unemployment tax on everything on the first few paydays. January, February, maybe March. So this is the only thing that changed. We pay state and federal unemployment tax on the total amount instead of 40,000. All right, now number 3, wage and tax statement data on employer FICA. Don't know if we can do this or not. We can. You don't have the chart. You don't have a payroll register, but you do have group earnings, federal income tax withheld, Social Security tax withheld, and so forth. Now this is when these people are employed. All right, go down to Cruz on problem 3. He was employed in January, and what is calculate the amounts to be reported on each wage and tax statement for 2000 Y8 arranging the data. Now this is for a whole year. So $5,500 times 12, no, wait a minute, $4,800 times 12. What was his total salary for the year?
$57,600.
All right, he would pay full Social Security all the way and full Medicare all the way. Now go down to next on February the 1st. He's got 11 months at 10,000. What's 11 months at 10,000? 11 months at 10,000. He made how much for the year?
100,000.
110. Now Medicare of 1.5 is on the whole amount, 110. But Social Security, I don't know what limits they may have given you. You have to have a limit on the Social Security. Medicare state unemployment tax is 5.4 on the first 10,000. Federal unemployment tax 6 points on the first 10,000. Now we know that after they make 10,000, excuse me, you don't pay any more federal and state income tax. That was the trick to this problem. But now I think that one employee that made 110,000 might have went over the Social Security amount that this book has. The Social Security is only on the first 100. You don't deduct on his last 10. So anyway, we'll finish looking at that problem later. See if you can work it out between now and Thursday, even though it was due today. All right, now we're going to go to chapter 12 for the rest of this period. For Thursday, read chapter 12. For Thursday, finish problem 3. For Thursday, have Cengage finished, and we'll be finished with chapter 11 on Thursday. If anybody wants to work the problem on page 579, that's comprehensive problem 3. You'll probably have to download you some journal entries and so on, and maybe do some statements. But if you want to do that problem, it will be worth at least 5-point bonus on your first test, maybe as high as 10.
What number?
If you want to work that comprehensive problem on page 579, it'd be worth between 5 and 10 points on the next test. All right, excuse me, this next chapter is partnerships. All right, on partnerships, we've been studying proprietorships, one owner. Now there's going to be 2 or more owners. Why would people take in a partner?
Sharing the liabilities.
Sharing the liabilities, or if it's a loss, sharing the losses. Any other reason to take in a partner?
Partner might be able to introduce new ideas.
All right, maybe new ideas.
Business growth.
What?
Business growth.
Business growth. You're growing, you need a partner to help. Now you might take in a partner because of his skills. A lot of mine operators took in accountants and lawyers and so forth as partners when they got some of these coal mining companies started. They took in partners with different skills. Why would you take in a famous person as a partner and not even have him to donate any capital? Why would you take in a famous person as a partner?
Popularity.
Not advertisement, popularity. Different reasons you're taking a partner. All right. A partnership is probably one of the worst kind of our business formation. I like partnerships, I like corporations. I don't like partnerships, but we need to look at it. I've been in 2 or 3 different partnerships, tax practice, accounting practice, and used car business. So I know the pitfalls of partnerships. Now, who in here is married? Just got one married here. Is married to partnership? Now, in Chris's case, marriage is a corporation. His wife is the president, the treasurer, and Chris is Lacey. Okay. Okay, so a partnership, some advantages of it would be you get more money, more capital to grow on. Now, the disadvantage of a partnership are the same as a partnership. You've got that liability situation. You're still liable. You're even liable for your partner's debts. You ever take in a partner, make sure they're bonded. They make a debt in your name, skip the country, if you've got them bonded, and insurance will take care of it. Bonded is just an insurance. All right. Now, one of the biggest pitfalls of a partnership is disagreement. Partners disagree, don't they? So if you ever go into a partnership with anyone, even if it's your parents or your brother or your sister, make sure you got a good agreement with that partner. Okay? That covers who puts in how much work, how much capital, how much you get per hour for working, what have you. Now, in a marriage, what do you think number one cause of divorce is? Finances. Number one cause. All right? That's where even a married couple should have an agreement with finances and so on. And you know, the top 10 there is other things. Adultery, mother-in-law, children even cause divorces. So top 10 there somewhere. But finances is number one. Okay. And a partnership, disagreement is number one cause of failure. And a lot of times it's over finances that you didn't have written out in the agreement. Now, in a partnership, we're going to have to look at how we split capital. So without looking at PowerPoint, we'll look at all right, we're going to split partnership income on some basis. Now, if there is no agreement, let's say partner B and R, they donate capital of $20,000 apiece. All right, let's say their income, net income for the year was $30,000. If there is no agreement, how do they split that $30,000? Equally. That's common sense. No agreement, they split it equally. All right. But they could also, in a ratio or a percent, let's say Batman decided to get 60% and give Robin 40%. I guess that's what those letters stand for. All right, so Batman and Robin. Okay, now we have 30,000 income. How do they split it? How much does Batman get?
18,000.
All right, 60% of 30 is 18,000. And 40% of 30 is?
Well,
all right, now they may want to split according to ratio of 3. Let me change that. Of 5 to 3. Now, do you know that ratios and fractions and decimals and percents are all the same thing? So first off, you change this to a fraction. The total of 3 and 5 equals what? 8, doesn't it? So this is 5/8 and 3/8. And we know that 5/8 as a decimal is decimal. Well, it's 62.5%. You can divide 8 into 5 and find that easy for yourself. And we know that's decimal 625. So decimals, fractions, percents, and ratios are all the same thing. All right. Now, to practice that a little bit, we got 3 partners. I guess we got Batman and Robin. We got to have Catwoman or somebody. Okay. I'm going to give her 40,000. All right. Now let's say that they want to split salaries in a ratio of 3 to 2 to 1. Now give me those fractions. 3, 2, 1.
3/6, 2/6, and 1/6.
That's your ratios. If they had 30,000 salary, 3 6s is half of that. 2 6s times 30,000 will be 10,000. Yes. And 1 6 will be 5,000. All right. But again, to practice these, they're all over chapter 12, and that's why we're getting a head start on them right now. Give me the fractions and the percents. Give me the fractions and percent. Okay, Morgan, what is 5/10 as a percent? What? 0.5? That's a decimal. Give me a percent of 50. Kelly, 3 is 3 over what? The fraction, 3 over what? All right, dear, that adds up to 10, yes. And 3/10 as a percent is?
30.
And then, of course, 2/10 as a percent. So we know that 50, 30, and 20 adds up to 100 also, don't we? And we know that 5, 3, 2, 1 adds up to 10, which is a whole. All right. Okay, now I want you to split 50,000 income, the Batman and Robin and Catwoman, according to the ratio of their investment. Do that according to the ratio of their investment. Millie, do you have an answer yet? How much of this 50 are you going to give Batman? She says 40%. How much will you give Robin? You give Batman 40, you'd have to give Robin 40. That'd only leave 20 for Catwoman, and she has the biggest investment. So, no, can't buy those. All right. Somebody else try.
Yeah, 12,500 to Batman and Robin, and then 25,000 to Catwoman.
12,500, 12,500, and 25. All right, we have to get that some way. And Of course, these are ratios too, if you want to look at them that way. I'd just drop all the zeros and I'd come up with 2 to 4. That's 8, 2 8, 2 8, 4 8. Or you can add up the whole and that's 80,000. And what part of 80,000 is 20,000?
1/4.
That's the 1/4 in. And 1/4 of 50,000 is 12,500. 1/4 is 25%. All right. Now, I'm going to guarantee these folks some other things. I'm going to give them interest of 5% of their investment. And I'm going to give them a salary. I'm going to give them a salary, Batman, of at least 10,000 a year, and Robin 10,000 a year, and Catwoman's going to take 15,000. Now, I would ask you to split the remainder in a 1 to 2 to 2 ratio. Now, see if you can give them a salary of 10,000, then give them interest of 5% on their investment, and split the difference in a ratio of 1 to 2. And let's say the net income, I'll give you a nice round figure of 100,000. Split that 100,000 with these 3 people. Give them interest, give them salary, and give them the difference. Okay, how much interest did Batman get? 5% and 20,000 is how much? 1,000? And Robin gets 1,000, and Catwoman gets 2,000. Wait a minute, 2,000? Now add up what we have here. I don't have enough margin here, but we'll see if I can write over here. But add up 10 plus 10 plus 15. That'll give you how much? Yeah, and I can't write over there. Let's see. All right, that gives you 35,000. 1 plus 1 plus 2 gives you how much? 35,000, and 4 gives you how much? How much? And that leaves how much? 61. And we're going to split up that 61 on the basis of what? 1, 2, what?
1 to 2.
All right, so how much does Batman give that 61,000?
12,200.
12,000 what?
200.
And Robin?
24,400.
And Catwoman? Now, all this together's got to add up to be 100,000, don't it? So, Batman, when you make a journal entry and do a closing entry, we got a debit income summary and credit Batman capital for 3032. Income summary will be 100,000. All right, and of course, Robin would be 35.4. And wait a minute, does that make sense? This is a 2, isn't it? 23.2. All right, 35.4. And this should add up to be what? 40 what? Or is it 51? Add the 3 together. What do you get? 41.4?
Yeah.
All right, now add these 3 across. And what do you get? Make sure that's 100. Is it 100? All right, you got an idea of what I'm doing there to split salaries? That would be the hardest scenario in the chapter, unless one partner had a negative. But let's go ahead and practice one more of those. We'll go with just simply X, Y, and Z this time, and their capital. That's their capital, 120,000. Now we're going to pay X a salary of 20,000 a year, and Y, let's give him a salary of 25, and Z 25. Let's give them 10% interest on their investment, and we're going to make this year 150,000 net income. Now, see if you can give them their salary, their interest, and split the difference in a 1 to 2. Don't want to use that same one. Yeah, that's okay. No, that's 7, isn't it? 2 to 3 to 3. All right, we're gonna give X a salary of 20, Y 25, and Z 25. That's 70,000. We're gonna give 10% interest on the investment, which is 5,000, 4,000, plus 3,000. That adds up to 12,000. All right, we have 150 down here that we want to give away. So how much do we add here? How much do we need to get 150? 82 from 150 is how much? All right, we got to split 78,000. 68?
Isn't it 20,000 total?
All right. Now, how do we get the difference? We give out salary of 7. We give out interest of 12. That's 82. Subtract 82 from 150. And that's 68. That's how I got to 68. Now I'm going to make these equal horizontal and vertical. All right, now the ratio I gave you was what? 2 to 3 to 3. That's 2 eighths, 3 eighths, 3 eighths. So how much is this 2 eighths, which is 1/4 of 68,000, does X receive? One-fourth of 68. I seem to be bigger than 8,500. How much?
17,000.
17,000. Okay, Margot. I don't know. I'm asking you, dear. 1/4 is 25%. Just multiply 68,000 times decimal 25.
What was it, decimal 25? Oh, wait, I used the wrong decimal.
2 to 3 to 3.
I used the wrong ratio.
All right. That's either 1/4, 2 eighths, or 25%. All right. Just remember, fractions, decimals, and ratios and percents are all the same. Okay. So what is 3 eighths of 68,000? All right. This would be 25/5 also, wouldn't it? 25/5 and 25/5 is 51 plus 17 does equal 68. Now let's see how much capital increase each partner has. 20 plus 17 plus 5. Keep me straight on my addition. 42. This looks like it would be 54. 54/5. And this looks like it would be, for whatever reason, 53/5. If I've added right, those will equal 150,000. So see if 42,000, 54/5, and 53/5 will equal 150,000. I think it does it? 42 plus 54/5 plus 53/5. Or I may be over 1,000. I don't know. Let's see. No, 8. No. Somebody add this? 42 plus 54/5 plus 53/5. I know 54/5 and 53/5 is 108 plus 42 makes 150. All right. Takes you all forever to add for some reason. Okay. Now, I wanted this to add up horizontal and vertical, and it did. Now that's as hard as you're going to get to split one, okay? Unless we have a loss, and unless one of these partners, this is a loss here, but this is about as hard as it gets in this chapter. So we will be, when you read this chapter, and even start Cengage when you can, and we'll really get into it come Thursday. All right, but if you have a book, I want you to look at page 589. If you have a book, or look at somebody else's book, someone else look at page 589. Kendrick was able to get his book to get an ebook.
Yeah, I got an ebook.
How much you have to pay for it?
34.
That gives you Cengage also?
Yeah, no,
Not bad, is it? 34 for some months.
yeah. It gives you 120-day access for it.
That should be enough. Okay. Who else is leading for Carson? You got a book in? Anybody else? Franco.
Yes.
You got a book yet?
Where is it?
Just the access code.
Access code.
Yeah.
And Cengage. Now, how many books do you four have to share amongst you? Y'all do? Okay.
Wow.
All right, if we're looking at page 589, we're going to start a partnership. The journal entries are no different than a proprietorship. However, if you look at this entry, the entry to record the assets and liabilities contributed by Stevens is below. Now, he's contributing cash, he's donating his accounts receivable, he's donating his inventory, he's donating store equipment, he's donating office equipment. We pick up his bad debt expense, allowance for doubtful accounts, his accounts payable. So we're going to give Stevens capital of $54,000 in this new partnership. Now, what is the other partner? You can give cash, you can give inventory, you can give vehicles, and so on. But now, one thing I didn't mention on splitting income is services of a partner. Now, let's say Margot and Kelly have a business. They're partners. And they split salaries. They split the income according to the time they put in the business. Well, let's say Margot works 2 times as much as Kelly. What is my ratio? What? 2 to 1. Or you could make up a scenario. Margot works 40 hours. Kelly works 20. That's 2 to 1. And that's going to reduce down to 2 to 1. So you can split salary according to time devoted to the business, okay? And that's what they're trying to tell you on page 591. And what you're looking at on page 590 is divided income. And that's the next few pages. When you start a partnership, you just got more than one person. Now, what type of businesses tend to be a partnership? Do you know of any partnerships? What? Law firms, a lot of times, 2 or 3 will go together and form a partnership. But then they'll probably change it to an LLC or something. Maybe a liability company.
Heating and cooling.
Heating and cooling, okay.
J&J Heating and Cooling.
Right. A lot of construction people, they have partnerships. There's even been partnerships with 2 doctors and so forth. So proprietorships has the most organizations in this country. Corporations owns the most assets. They have the most sales, the most revenue, the most employees in this country. But there's a lot of proprietorships. In between are partnerships, okay? All right, the rest of this chapter. Now we're going to talk about adding a partner, death of a partner, withdrawal of a partner other than death, and liquidating a partnership. Now, if a partner dies and that partner left his half to his brother, it's a new partnership. You need to write up new agreements. So when one partner dies, that partnership is dead. You liquidate it, start another partnership, even with the deceased person's family member. All right, we're going to have gains or loss on liquidating. So you see what you're in for. I'm going to give you time to read this chapter real well between now and Thursday. And a statement of capital, you know, we have a balance sheet, a capital statement, or owner's equity statement, whichever. And then you have an income statement and balance sheet and the capital statement. Later we'll get to big 4, which is the cash flow statement. We haven't done that yet. We'll get it though. But a capital statement for a partnership is no different than a proprietorship. You just have 2 or 3 people making a partnership. Now, some of your big accounting firms, I think, are down to, used to be a big 8, then used to be a big 6. And when Enron went down, it took down one of the major accounting firms in the country, down to 4. They do a partnership. They have over 600 partners. They do not want to incorporate. They feel like if they incorporate, that releases them from liability. And companies wouldn't trust them as much, so they stay a partnership. But if you get to be one of those 600 partners, now Mr. Bourne, Dr. Bourne's daughter, is working for one of the big 4, I forget which one. She is moving up to a partnership. She went from just a worker, auditor, and I think she went up to a supervisor, a manager, what have you, and a partner. The salary for a partner in one of those big accounting firms is over $250,000 a year. So they've been waiting, okay? All right, that's what Jessica wants in her lifetime, to be a partner in one of the big accounting firms. Okay, all right. I want to let you go in a minute, but I wanted to compliment you on your attendance. There's 24 in this class. 26 had signed up. 2 did not qualify because they did not pass 201. Okay? They didn't take the exam in 201, but they thought they could take 202. So that leaves us 24. One person's live streaming today and 22 of you here. Now, if you keep attendance up like this, it makes me happy. And I'll give more bonuses and more curves if you keep this good attendance up. See you Thursday.